Treasury Secretary Scott Bessent just told the world's top CEOs to start buying U.S. assets. Like the U.S. still runs the show in global finance. In reality, it sounded more like a threat. Buy our debt, or face the consequences. That's not diplomacy. That's coercion. And it's straight out of Trump's playbook since returning to office too. But here's the kicker. Even with all this pressure, the dollar is tanking. It dropped 10% this year, marking the steepest crash in half a century. No wonder investors are running for the exits. The U.S. is drowning in $37 trillion of debt and plans to borrow another $514 billion this quarter alone. At this pace, that's nearly $2 trillion more by year's end. If that doesn't set off alarms, maybe this will. In April, foreign investors dumped $71 billion in U.S. bonds. China alone offloaded $23 billion. Meanwhile, gold is soaring. $15 billion poured into it in just one day, as faith in the dollar evaporates. At the same time, the U.S. is hammering China with 50% tariffs, despite a supposed trade deal. It's already costing companies like Apple $900 million, slashing imports by over 19%. And yet, Bessent keeps projecting calm as if nothing's wrong. But consumers are spooked. Growth is crawling at 0.3%, and markets are showing signs of panic. America isn't leading. It's begging. Before we dive deeper into this unfolding story, make sure you're subscribed so you don't miss the real economic analysis the mainstream media won't touch. Scott Bessent's speech wasn't a policy update, it was a performance. He painted the U.S. as a land of opportunity, claiming it's uprooted waste and planted growth. But let's be real, this was a cry for help. The U.S. dollar had just tanked 10% since January per Bloomberg, and foreign investors were offloading $41 billion in U.S. Treasuries in just 2 weeks. Japan and Germany, key bond buyers, hit pause, spooked by currency swings and tariff chaos, according to the Financial Times. Bessent called the U.S. the shelling point of global finance, a fancy game theory term for a place everyone trusts to invest in. But when capital is fleeing and the dollar's in free fall, that trust is shaky at best. The Bank for International Settlements noted in the second quarter of this year that central banks are diversifying away from dollars into euros and gold, with 38% of global trade now bypassing the dollar. Bessent's talk of deregulation and tax cuts sounds nice, but the Congressional Budget Office warns these could add $2 trillion to the deficit by 2030. This isn't leadership. It's a salesman pitching a sinking ship. The question isn't whether Bessent believes his own hype, it's whether anyone else does. HSBC's Q2 2025 investor briefing shows big players shifting to euros and Swiss francs. With the euro moving from 1.09 to the dollar to 1.13 on the index, that is over 11% gain over the dollar in just a few weeks since April, and also marking the greatest leap of the euro since 2021. Why? Because Treasury yields at 4.9% don't cover the losses from a falling dollar, especially with inflation still above the target level. The IMF's July 2025 World Economic Outlook points to a bigger issue, which is de-dollarization. More countries are trading without dollars, and that's a problem when America relies on its currency to fund its massive debt. Bessent's claim that U.S. markets are a safe haven ignores this reality. Liquidity without trust just speeds up the exit. It's like inviting people to a party while the house is burning down. Investors aren't buying the invite. They're grabbing their coats and heading for the door. America's tariff war is hitting its own companies hardest. Tariffs on Chinese goods now average 50%, and the White House's May 2, 2025, decision to end the de minimis rule, taxing all imports under $800, has sent costs skyrocketing. Apple's CEO admitted on May 1st that the company faces a $900 million tariff bill this quarter if you do the maths. It quickly adds up to about $3.6 billion in added cost per year for Apple. The U.S. economy is on edge as cargo ports face a wild roller coaster. July's import volumes are set to rebound, hitting 2.36 million containers, up 2.1% from last year, as retailers rush to stockpile goods. But brace yourself. Experts warn of a sharp drop starting August, when delayed tariffs kick in. The Global Port Tracker report, released July 9th, predicts a grim 10.4% plunge in August and a jaw-dropping 21.3% collapse by November. The reason is President Trump's new tariffs, including up to 40% on over a dozen countries, are shaking things up. Retailers are panicking, scrambling to import holiday goods before costs soar. These tariffs aren't paid by foreign countries. They hit U.S. companies, driving up prices for everyday Americans. Small businesses, already stretched thin, could get crushed. The National Retail Federation says the tariff uncertainty is impacting them negatively. Retailers can't plan, and families will feel the pinch with higher prices and fewer products. The global supply chain thrives on stability, but Trump's erratic policies are causing chaos. With China tariffs still looming despite a recent deal, the forecast is bleak. Holiday shopping could take a hit, and American wallets will pay the price. The U.S. Chamber of Commerce reports that importers of solar panels, chemicals, and electronics are seeing profit margins shrink by 30 to 40%. A July 2025 National Bureau of Economic Research study found that tariffs have raised consumer prices by 2.4% in May and 2.7% in June, hitting low-income families hardest. Logistics firms like Maersk are reporting 15% higher shipping costs as they reroute away from China. Bessent talks about long-term resilience, but businesses are choking now. It's like telling a drowning person to focus on their swimming lessons. If even giants like Apple can't handle these costs, how are smaller companies supposed to survive? And behind all this tariff chaos is one undeniable truth. America can't afford to go it alone, especially not without China. For years, Americans believed that China needed the United States more than the other way around. This belief shaped trade policies, tariffs, and even diplomatic strategies. But that illusion is now fading fast. In fact, the uncomfortable truth is that the U.S. needs China in more ways than it dares admit, and not just for cheap imports. China remains the largest foreign holder of U.S. Treasury securities, owning over $756 billion. While it has reduced its holdings in recent years, its influence in the American bond market is still enormous. If China ever dumped these holdings in large volumes, it would cause a spike in U.S. interest rates and shake confidence in America's ability to finance its debt. The U.S. relies heavily on external buyers to fund its spending, and China has been one of the most reliable investors. Now Beijing is diversifying into gold, euros, and other assets, quietly signaling that it no longer wants to carry the burden of supporting U.S. deficits. On top of that, China controls many of the materials the U.S. tech industry depends on. It dominates over 80% of the global rare earth supply chain, which the U.S. desperately needs. Washington's efforts to build domestic alternatives are years away from producing any real results. Meanwhile, the myth that American consumers can hurt China by buying elsewhere is proving hollow. Most American retailers still source from Chinese factories because no other country matches China's scale, speed, or logistics. China isn't begging for U.S. trade. It's building alternative markets across Asia, Africa, and Latin America through its Belt and Road Initiative. The world is no longer leaning on the dollar, and certainly not on America's promises. As trust in America's financial leadership fades, countries aren't just backing away from the dollar. They're rushing to something far more ancient: gold. Gold prices are exploding, hitting $3,360 an ounce in July 2025, up nearly 40% from last year. This is a loud warning that the world no longer trusts the US dollar. Countries and banks are racing to buy gold, fearing economic chaos and trade wars. Even US experts are sounding alarms about the dollar's collapse. America's grip on global money is slipping fast, and it's time to pay attention. Gold's climbing fast, and it is the central banks that are grabbing it up, with China and Poland leading the pack. In early 2025, they bought 244 tons of gold. China, fighting a trade war with the US, boosted its gold stash by 50 tons in February alone and has continued to buy gold every month till now. Through investment funds, Poland's bank added 90 tons last year, aiming for 20% of its reserves in gold, and was the highest buyer in 2024. The World Gold Council says 95% of central banks expect more gold buying in 2025, while 73% see the dollar's share of global reserves dropping to 57.7%, down 10% in 5 years. Countries like China and other BRICS nations are trading in their own currencies, sidelining the dollar. JP Morgan predicts gold could hit $3,675 by late 2025, maybe even $4,000 by mid-2026, as trade chaos and a weak dollar fuel the surge. Even Americans are worried. Economist Peter Schiff warned that the dollar's dominance is over. Life in America will change fast. This spells trouble for regular Americans. A weaker dollar means higher prices for everything, from groceries to gadgets, especially with tariffs already driving up costs. Small businesses are getting hit hard by supply chain messes. If central banks keep buying gold, possibly 900 tons this year, while dumping dollars, the US economy could face a crisis. But while central banks are shifting to gold and foreign investors abandon the dollar, America keeps digging deeper into debt, hoping the world will keep funding the deficit. But what if they don't? To make things worse, the US is borrowing like there's no tomorrow, and tomorrow's looking grim. The Treasury borrowed $514 billion in Q1 2025, with interest payments $1.1 trillion and expected to keep rising, eating up 20% of federal revenues per the CBO. Foreign investors dumped $71 billion in US debt in April, and a July 2025 Fitch Ratings report downgraded US credit to AA, citing tariff-driven fiscal strain. The IMF warned in July 2025 of a potential debt refinancing shock, with $1.6 trillion in T-bills maturing by Q3. The Federal Reserve's holding steady on rates, per its June 2025 minutes, because tariffs are keeping inflation out of control, but with negative real yields on US bonds and declining foreign demand, that anchor's dragging the economy down. It's like borrowing money to fix a leaky roof during a hurricane. If global investors keep pulling back, America's debt binge could spark a crisis nobody's ready for. All of this debt and inflation isn't just playing out in bond markets, it's hitting American households directly. The warning signs aren't just on Wall Street, they're showing up at kitchen tables across America. The Conference Board's Consumer Confidence Index dropped to a 12-year low. Meanwhile, the University of Michigan's consumer sentiment reading for July came in at just 61.8. That is 16% lower since December. Even though inflation expectations have slightly eased, dropping to 4.4% from 6%, that hasn't lifted the mood. Americans simply don't believe the future looks any brighter. This collapse in confidence is already showing up in retail spending. Yes, sales rose 0.6% in June, but that was driven mostly by essentials: cars, clothes, and healthcare. Discretionary spending on electronics and appliances is falling fast. In May, retail sales dropped 0.9%, with auto sales down 3.5%. Economists warn that June's small uptick might just be panic buying, consumers trying to beat another round of price hikes from tariffs. The financial pressure is mounting. A recent FINRA survey revealed that 26% of Americans are now spending more than they earn, the worst level since the 2009 recession. Only 44% say they can comfortably meet their basic expenses. Credit card delinquencies are rising, especially among middle-income families. Banks aren't ringing alarm bells yet, but they're already warning about growing stress in consumer debt and commercial real estate. This leaves the Federal Reserve in a no-win situation. Inflation is still hovering around 2.7%, just above target. But with confidence falling and spending shrinking, pressure is building to cut rates. The catch? Most consumers have little faith that help is coming. Big banks like JP Morgan and Bank of America say things are stable, for now. But Wall Street is uneasy. Beneath the surface, fear is growing. This isn't a soft landing. It feels like the prelude to something much deeper. If inflation stays elevated and tariffs remain in place, what we're facing isn't just an economic slowdown. It's a consumer confidence collapse at the heart of the US economy. And here's the truth. You can't power a nation on fear and borrowed money. America is losing the trust of its people, just as it's losing the trust of the world. So, how long can Washington pretend it still holds the reins, when everyone else is quietly letting go? To stay informed, subscribe to the channel and turn on notifications, because this story is far from over.